Diamond Trust Bank projects that Kenya's economy will grow by a faster 5.3% in 2026 compared to an estimated 4.9% last year, buoyed by improved government spending, low inflation and domestic demand. The forecast matches that of the National Treasury, which showed that a resilient services sector and agricultural productivity would drive economic rebound in 2026. DTB said that accelerated economic growth, well-managed inflation, strengthening labor markets and favorable central bank policy actions are expected to support a gradual acceleration in household incomes and spending. Lending to private sector saw a surge across East Africa in 2025 against the backdrop of lowered lending rates by the Central Bank of Kenya. According to Diamond Trust Bank's inaugural economic outlook, despite the easing bias, the direction of interest rates will be hinged on the government's borrowing plan, with elevated domestic borrowing plans likely to exert some modest upward pressure on yields in the year. NTV's Brian George reports.
Credit to the private sector has accelerated 10% in Uganda, 18% in Tanzania and 6% in Kenya as an attractive new risk-based pricing model adopted in 2025 skyrocketed borrowers' appetite to access credit to finance businesses. This is a recovery from a decline during 2024. By June 2024, the annual growth slowed to about 4%, down from much stronger growth in 2023. This was the slowest pace in several years, driven by higher interest rates and a stronger Kenya shilling, reducing foreign currency loan valuations.
So if you go back to January 2025, the central bank's steered monetary policy committee had projected that private sector credit growth was actually shrinking at about 3% per annum. 12 months down the line, the picture has pivoted. We've seen a positive growth of over 6%. So overall, we've seen a 9% shift in terms of credit access to the private sector generally. And we believe that as interest rates continue to remain and sustain into a normal cycle, then we will see private sector credit grow.
Overall, the CBK benchmark lending rate, often referred to as central bank rate or CBR, declined in several steps from 11.25% at the end of 2024 down to 9% by December 2025, a cumulative drop of 225 basis points or 2.25 percentage points during the year.
We are confident also that with the implementation of the new risk-based pricing model that will respond as desired more effectively in terms of transmitting the monetary policy that government is pursuing and pushing into the economy by way of its impact on interest rates. Already we have seen interest rates which are at a high of 17, 18, 19%, 15, 16 months ago being reduced. On average, interest rates are now at 15% or below, and we are expecting that to shift further downwards as the government eases its monetary policy cycle.
Other than the downward revision of the lending rates, experts opine that the price transparency on interest rates and other cost of borrowing will be responsible for driving credit uptake in the private sector, further cascading a positive economic effect.
Suffice to note that the Monetary Policy Committee sits tomorrow, the 10th of February 2026. And as experts opine, it is their hope that by the close of the year, the central bank lending rate would have been lowered by 50 basis points to 8.5%. Brian George Otieno, NTV, Nairobi.